Well, thank you, Larry and Zeifmans, for inviting me to this event. It's my pleasure to be here this evening. My name is Jim Wall. I'm a tax partner with Cohen Resnick in New York, and we are a Nexia member firm. And I see Steve Roth sitting in front of me. He's one of the first persons I ever spoke to at Nexia, I think, when I started. And it's amazing. Still here. Anyway, so what I'm going to talk about is to kind of add on to some of the stuff that Nathan was covering, but probably more along the lines of cross-border rules as opposed to purely domestic rules. And I boiled mine down to I think it's 7 bullet points, right, that I wanted to cover here this evening for you. And that's 5 fewer than Donald Trump put on his original tax plan that he issued as the blueprint for what our tax reform would be. And we ended up with more than 1,000 pages. So the tax reform in the United States is the largest tax reform that we've had since 1986. Unfortunately, I happen to be old enough to have remembered the '86 Tax Reform Act and went through that as a professional, but now I get to live through another one. So the first piece I think that I wanted to touch on was it's actually a retroactive provision that was in the law. And to kind of set the stage for this, the U.S. thought that our international tax system was broken, right? Because we had lots of U.S. multinationals that elected to permanently defer their income outside the United States. They didn't have to record a tax provision for that on their books in the United States as long as they permanently kept the money outside. So there was lots of newspaper articles about the likes of Apple and Google with trillions of dollars outside the United States that they had never paid U.S. tax on. Everybody thought that was a bad system. We looked at the systems around the world. This territorial tax system that you may have heard about was something that was appealing to the U.S. That's what they have in the U.K. That's what they have in the Netherlands. They have it in Japan. A lot of our major trading partners have a sort of a territorial. Canada has a little bit of a system like that, but not exactly. Anyway, so we wanted to go to the system because under that system, for example, in the Netherlands, they don't tax dividends that come up the chain from lower tier companies, and they don't tax capital gains that are incurred by Dutch companies when they sell lower tier subsidiaries. That was thought to be a better system. So we wanted to go to this territorial system, which is what we enacted. But before we got there, we decided that all of these companies that had trillions of dollars outside of the United States, we were going to make them included in income and pay tax on it in the United States. So what we did is we took our old Code Section 965, which was part of the 2004 Tax Act that allowed corporations in the United States to voluntarily bring money back to the United States and pay a 5.25% tax on it. That was voluntary. This new rule is involuntary. It's mandatory. All U.S. shareholders of controlled foreign corporations are required to include in their 2017 income tax return, or the first fiscal year thereafter, if it happens to be a fiscal year U.S. shareholder, 100% of the earnings that were earned outside the United States, accumulated. And that means all of the earnings going all the way back to 1987 if the offshore entities happen to be around that long. So this is a massive undertaking because most companies never calculated their earnings and profits on an annual basis. And it was designed to be done on a consolidated basis. So if you had positive earning controlled foreign corporations outside the United States and deficit companies, you get to net the deficit against the positive. No one ever tracked their deficits. Why would you? Because you couldn't possibly have an income inclusion. So whether you were off by $1 million or $2 or $3, nobody cared, right? Because it just didn't matter. Now it matters. So basically the earnings and profits that you have to track and include in the 2018 return is, sort of your retained earnings, but adjusted for U.S. tax principles. Sounds simple, but it's a huge amount of work. And, I'm actually working with public companies now who have, already filed their SEC filings, and they still have no idea what the amount of, the inclusion will be by the time they file their return. So the rules are pretty complex, and what they also make you do is measure your cash and measure your non-cash earnings, and there's a different rate of tax that applies to each. And if you're in a consolidated basis, you got to net your accounts receivable and accounts payable and all those sorts of things against each other. It's a massive undertaking that we've been working through since the law was enacted in December. And for what happened was, the way that they set this thing up was that you're allowed to take an election to pay the tax on installment basis over 8 years, right? So it's backloaded. In the first year, you have to pay 8% of the amount of the tax due, but it had to be paid with the first due date of the return. So for calendar year taxpayers, that was April 15th, or actually April 17th this year because of holidays. So we scrambled like mad to try to get this done, but in almost every case we guessed, because we just didn't have enough information to be able to gather it and get it together. And we're still going to work it through over the summer to get to the point where we've got a reasonable number that we can put on a return that's going to get filed in September. And for fiscal year taxpayers, you know, it stretches out longer because they don't have to report this until their return is due for the first fiscal year thereafter. But there's huge uncertainty involved in the rule in terms of the way that, for example, the previously taxed income rules work and the basis rules work. It's not clear exactly what you can distribute out tax-free, because the normal rule is that once you pick it up into income, you can then distribute it out of the foreign companies without any additional tax. But because of the way that we net deficits against positives, the rules don't exactly work right. And so we're waiting for more guidance from the IRS in terms of how all those rules work, because there's some rather strange results that come out of it. But that's been this massive undertaking that's been going on. And that was sort of, you know, part one of the Tax Act, and it's really kind of consumed us in the US over the last few months. The next piece is that the government, in kind of going to the territorial system where they would no longer tax dividends that came from non-US corporations that were owned by corporations, is that they decided that that was too good a deal, right? So we've always had these anti-deferral rules in the United States for, you know, and the tax geeks in the room would know about Subpart F income, which was this type of income that was earned by controlled foreign corporations that would hopscotch out of the company and required to be included in income by the U.S. shareholders. This is something that we'd struggle with on an annual basis for our clients, but it was always done on a CFC by CFC basis. What Congress came up with is this new provision, which is called Global Intangible Low Taxed Income, and the acronym for that is GILTI. And it's a new category of Subpart F income. Some would say it's Subpart F income, some would not say it's Subpart F income, but nevertheless, it's an income inclusion that comes out, and basically it's a mechanical formula. You look at 10% of the return on your tangible depreciable assets in your offshore companies on an aggregate basis, and anything above 10% is GILTI, and it hopscotches out of the company, and it's taxed in the United States. So if you're a service business, a tech company, a pharma company, almost 100% of your income is going to be GILTI if it's outside the United States, and it's all going to be taxable in the United States under these GILTI rules. If you're an individual that owns one of these offshore companies or a trust, for example, it's a disaster, because you're going to be subject to tax at the highest U.S. tax rates individually, which is 37%, plus you get no foreign tax credits. So your effective tax rate on your earnings outside the United States is probably in about the 60 to 70% range. Awful result, right? So individuals that own these companies have to restructure in a way to either own it through a corporation, which has a much better result. Corporations are subject to tax at 21% now, as Nathan mentioned, but on GILTI income, they get a 50% dividends received deduction, which brings the rate down to 10.5. Plus, they can use credits against that. 80% of their taxes that are paid in the local jurisdiction are eligible for credit. So in a lot of cases, that'll probably wipe out the GILTI income if the entity is owned by a C corporation in the United States. However, they've made the foreign tax credit rules around GILTI hyper complex, and it's going to create lots of extra cost in terms of doing the compliance for US-based companies with operations outside the United States. So the days of being able to do tax compliance where you could sort of report the information that would go on the foreign information reports in the United States for a couple of $1,000s, that's over. So we're going to have to do foreign tax credit calculations for every foreign CFC. It's going to become a much bigger ordeal. Not that you'll actually get to use any of the foreign tax credits, but you're going to have to do the calculations and put it on the return. So it's going to be a lot more complicated. All right, so this is all bad news, I think, for businesses for the most part, the mandatory inclusion and the GILTI. But then we had actually a good piece of news, which is this thing called FDII, and that's Foreign Derived Intangible Income. We call it FDII. Has nothing to do with the rapper 50 Cent. It's just FDII. All right, so this is actually a low tax regime that applies only for C Corps, for export sales of property, and for export services. And it's basically, if you have a return on your tangible depreciable assets above a certain level, you get a 13.125% tax rate on that. And this is going to all be mechanical. It's kind of like the old manufacturing deduction that we had in the United States, where you're just going to have to go through and do the math to figure out whether you get the benefit, but it could be a significant benefit for US exporters. We have to wait and see if the WTO comes out and says that this is an unfair export subsidy for US businesses, which they've shot down several US tax regimes over the last 20 years that they said were unfair export subsidies, but this one, who knows what's going to happen. And then it brings us back to the whole reason for this tax reform in the United States for the international side, which was the territorial system, the participation exemption. But it's a false rule. It hardly applies to anyone. It only applies to that first 10% of the return on your tangible depreciable assets. And it only applies to C corporations. It doesn't apply to any other US shareholders. And we also don't have a capital gains exemption if a US C Corp sells the shares of their foreign subsidiaries. So we say we have a territorial system, but it applies to almost no one and no income. So it's there, but it's kind of useless, to be honest. Anyway, but that's our territorial system in the United States. All right, so that's kind of like a very high-level overview of what I would call some of the outbound provisions that applied in these new rules. That's to U.S. persons that have investments outside the United States. And the next three are really for sort of inbound provisions for inbound into the United States. The first one is really, it applies both inbound and outbound, but we revised our interest expense limitation rules. We used to have this thing that we called earnings stripping, which we basically borrowed from the Canadians and the Brits. And it's really a limitation on interest deductions if companies are too thinly capitalized. Ours used to be where you couldn't deduct more than 50% of the cash flow on related party interest payments that were made unless you had a debt to equity ratio of less than 1.5 to 1. This one now, there's no safe harbor 1.5 to 1. It applies to all payments of interest, whether it's to a bank or unrelated person as well as related persons. And it's now come down to 30% of EBITDA. It's 30% of interest income plus EBITDA is what your interest limitation is, but it's a deferral, not a denial. So if, for example, you're unable to take an interest deduction in a particular year, you can roll forward any excess interest into future years. So a lot of times, like for example, in real estate investments, there'll be a limitation on the ability to deduct the interest, but as every real estate professional will tell you, we're going to sell for a huge amount 5 years from now, and then we'll be able to use the interest deduction. So it's just a deferral, not a denial. And it also applies to partnerships. The old 163J that we used to have, the earnings stripping rule, it only applied to corporations. In the partnership context, they came up with this insanely complex set of rules for how the interest limitations apply. They apply at the partnership level, but then roll up to the partners, but then there's different limitations on how they're being able to be used at the partnership, at the partner level. So I won't get into that, just be aware that there are a lot of complexities associated with that. The next thing I wanted to talk about was we used to have this old revenue ruling called 9132 that indicated that if a non-U.S. person sold an interest in a partnership that had what we called effectively connected income, which is U.S. trade or business income, that any gain realized by the partner on the disposition of that partnership interest would be treated as effectively connected income and taxed in the United States. And this provision was, roundly booed by people, and a lot of people said that it was, it wasn't reasoned properly, and it wasn't really, there shouldn't be a difference between the sale of shares in a corporation and shares and a partnership interest, particularly for a limited partner who isn't involved in the business. They should be taxed the same way. So a non-U.S. person who sells shares in a U.S. company is not subject to tax, whereas they were going to be subject to tax on the partnership. So someone fought it, took it to court. The Grecian mining case was decided in 2017, I guess, overturned revenue ruling 9132. 6 months later, Congress comes back and overturns Grecian mining and puts back in revenue ruling 9132 and says now you have to pay tax if you sell a partnership interest. Not only that, we're going to require the purchaser to withhold 10% on the gross proceeds on a sale of a partnership interest if there is ECI in the partnership. So they passed the law December 22nd. It's effective as of January 1st. We get to December 29th, and someone calls up the IRS and says, I want to sell an interest in a publicly traded partnership. It might have been Blackstone or KKR or something like that. And how do I tell whether there's ECI within one of those partnerships? So they suspended the rule for sales of publicly traded partnerships because they realized it was inadministrable and no one could ever figure out whether there was ECI or what the percentage of ECI was in any of these partnerships. But it still exists for private partnerships. And this has caused a huge problem in the fund world because you got to look through tiers of funds to figure out whether there are effectively connected assets inside the partnership. It's really inadministrable. They've issued a notice now to say they're just going to follow the FERPTA rules, which were the withholding rules for real estate, until we figure out whether this is administrable and something that we can live with. So that's a big issue that we're trying to work through is that. And then finally, this is loaded up with acronyms. This thing called BEAT, which is the Base Erosion and Anti-Abuse Tax. All right, so you read in the paper, I'm sure, that there were a lot of U.S. companies that inverted over the last 20 years. They decided to make the parent company a non-U.S. company outside the United States. I think Burger King did it through Tim Hortons to become a Canadian company. There were a number of others. I think BioVale maybe did it, a few others. Number into the UK. Tyco did it years ago into Bermuda. So the U.S. government thought everybody was doing that so that they could then strip all the earnings out of the U.S. in the form of royalties and interest and service payments or whatever, because you could, as long as you were within the transfer pricing rules. So this is really an attempt to stop that. But it has limited application. It applies only to U.S. C corporations, not to other types of entities, and it only applies if the C corporation had an average of $500 million of sales over the last 3 years. So it's only larger companies that it applies to, but basically it's like an alternative minimum tax that applies to companies if you have base erosion payments, which are interest, royalties, service payments. Doesn't apply to cost of goods sold, but if you reduce your income by more than 3%, then that difference is subject to a 10% tax. And it's just like an alternative minimum tax that applies. So there's a lot of hand-wringing around this particular provision. It doesn't only apply to payments made to foreign-related parties. It applies to payments made to CFCs also, if you were a U.S. company. So I actually had a client that we were working with that was a sort of like an Infosys type of business that had offshore programmers. They'd sign a contract in the U.S. with a big bank to do programming services and then make a huge payment to their subcontractor in Eastern Europe, and boom, all of a sudden they were in the beat. And they had this alternative minimum tax that would apply to them. So they've had to restructure their operations to get around that. So I would tell you that this statute, I believe the first day that they proposed it was November 2nd. It was enacted on December 22nd. It's probably like the shortest time period ever for a statute, particularly for a statute that was over 1,000 pages. And there are huge amounts of uncertainty. At the moment, we are advising most of our clients not to file their tax returns in the United States until they extend them out, because there are so many issues that we just don't know what the answer is, and we don't know how to report it properly on the tax return. We're hoping that over the summer we get enough information to be able to do that properly, but it's really a bit of an influx at the moment. So it's difficult for taxpayers. It's great for service providers like us because it just has created lots of work. But if you are grappling with these rules, you're not the only one, because it's really difficult and it's hard to get your arms around how it works. Any questions? Yes. Excuse me? Captain Kirk, maybe? I don't know. I don't know. I'm not sure I know what your question is. I'm just getting you. I don't know. They will, probably. You're probably right. Mm-hmm. Yeah, the interest expense is 25 million. Yeah, and what Stanley is raising is that on the interest expense limitation, there's a de minimis threshold where it doesn't apply. So if the trader business has less than $25 million of income, the interest expense limitation won't apply. But it's applied on an aggregate basis, let's say for a consolidated group, and there was a notice that it was issued that's clear. It's a little unclear how it's applied in the partnership context and to what extent you would have to include related partnerships in the $25 million threshold. There's also certain strange rules. So like if your investment or if your trader business is considered to be a quote tax shelter, and that's anything where you're using certain types of credits. So if you have a solar deal or a wind deal and you're accessing certain types of credits, the $25 million threshold doesn't apply. So it will apply at a lower threshold for those types of deals. But the beat is 500 million. Yeah. So that one's going to have much smaller impact on sort of middle market companies. The beat likely won't apply to most of the middle market companies.
Jim, you indicated that you advise not to file at the moment because of uncertainty.
Mm-hmm.
What are you going to do if the uncertainty remains?
Hope for the best. No, we're gonna file based on the best information that we have. Prepare the returns and advise our clients that there are uncertainties still, and the possibility exists that you might have to amend if it turns out that our interpretation of the rules is different than the IRS's ultimate interpretation of the rules. Yes. Yeah, that's right. Sure.